Two savers, same age 30, same day, their employer opens retirement enrollment for the very first time. Both of them also start with the exact same $70,000 salary, down to the dollar. One of them decides to funnel every spare dollar into the 401k first. The other maxes a Roth IRA first instead. Most videos comparing these two accounts skip the one number that quietly decides the winner, what your specific 401k actually charges. They also treat the contribution limit as the whole story, when the limit is really just the opening move. Here's the counterintuitive part. The account with the bigger limit and the employer match is not guaranteed to win by year 30. This video will show you the real fee gap most people never check between these two accounts. It will also show the real tax bill waiting at withdrawal and the exact contribution order that protects your free money. So which account actually wins, the one built for scale or the one built for control? Even the analysts running these numbers were surprised. Both savers start from the exact same paycheck, so the fair comparison begins before either one even picks an account. Before any 401k versus Roth debate starts, there is a step zero neither saver can afford to skip. If an employer offers a matching contribution, that match gets claimed first every single time, no exceptions. This saver's employer matches 4% of salary, dollar for dollar, the most common match formula in the US. That contribution comes out to $2,800 a year, funded entirely from the saver's own paycheck. The employer then matches it dollar for dollar, adding another $2,800 in completely free money. Skip that match to fund a Roth IRA instead, and you are choosing a good account over free cash. It sounds obvious stated out loud, yet plenty of savers still skip their match, chasing a better-sounding account elsewhere. Once that money lands on both sides, step zero is finished before any 401k versus Roth choice even begins. Here is the version most people already believe about this comparison, the one that sounds obvious on a thumbnail. For 2026, the 401k accepts employee contributions up to $24,500 a year. The IRA limit, covering both traditional and Roth combined, sits at $7,500 for 2026. That is more than 3 times the contribution room inside a 401k compared to an IRA in the exact same year. Add the employer match on top, and the 401k looks like the obvious place to send every extra dollar. By that logic, the saver who ignores the Roth IRA and stuffs the 401k should simply end up richer. The gap only widens with age too, since older savers can add an extra $8,000 in catch-up contributions to a 401k. No matching catch-up boost exists for the IRA anywhere close to that size, which makes the 401k look even more dominant on paper. On paper, every advantage seems to point toward one clear answer, which is exactly the trap most comparison videos fall into. But that logic assumes every dollar in each account grows at exactly the same rate, and that assumption is worth checking. That assumption about equal growth for every dollar in every account is exactly where the obvious math quietly falls apart. A 401k is not one single product, it is a menu your employer picked, and that menu carries its own price tag. According to 2025 research from the Investment Company Institute, the average equity fund inside a 401k charged a 0.26% expense ratio. That average hides real variation, since some 401k plans negotiate genuinely cheap institutional funds while others settle for pricier retail share classes. Your employer picks the plan provider and the fund lineup, and most employees never get a vote in that decision. A Roth IRA at a low-cost broker looks completely different since you pick the fund instead of your employer picking it for you. Vanguard's own fund lineup averaged a 0.06% expense ratio as of early 2026 after a wave of fee cuts. That number only holds if the saver actually picks a low-cost index fund, not just any fund sitting on the broker's shelf. Pick a pricier, actively managed fund inside that same Roth IRA, and the self-directed account can end up costing more than the 401k ever did. That gap sounds tiny written as a percentage, barely a quarter of 1 point separating the two accounts. But a fee is not a one-time charge. It is a toll collected every single year for as long as the money stays invested. Over 3 decades, that toll compounds right alongside your returns, quietly eating a slice of growth you never notice on a statement. It never shows up as a single line item either, which is exactly why so few savers ever go looking for it. The saver who assumed bigger contribution room automatically means a bigger balance is about to meet the exception to that rule. That exception shows up the moment you actually run both accounts forward through real years, not just theory. To compare fairly, assume both accounts grow at a steady 7% nominal return before fees, a common long-term illustrative assumption. Picture both savers contributing the same $14,800 a year, combining their own money with the employer match. One saver puts all of it into the 401k, chasing the bigger contribution ceiling and the higher single account balance. The other saver maxes the Roth IRA first, then routes every remaining dollar back into the 401k. Same total dollars saved every year, same market conditions, same 30-year runway, only the account order actually differs. At year 5, the all 401k savers balance has climbed to around $84,600 all inside one account. The split saver, at that same 5-year mark, holds roughly $84,800 across both accounts combined. Barely a difference yet, because 5 years is not enough time for a small fee gap to show its teeth. Stay with these numbers, because the real separation between these two savers hasn't even started to show up yet. Fast forward to year 15, and the all 401k balance climbs to about $364,000. The split savers combined balance reaches closer to $367,000 over that same stretch. The gap between the two balances is widening slowly, exactly the way compounding always starts quiet before it eventually gets loud. By year 30, the all 401k savers balance reaches roughly $1.33 million before any taxes. The split savers combined balance lands near $1.36 million over that same 30-year stretch. That is real money left on the table purely from fee drag, and fee drag alone was never even the biggest factor here. But the biggest twist in this whole comparison is still waiting at withdrawal, once the tax bill actually arrives. A Roth IRA works the opposite way since contributions go in after tax already settled with the IRS years earlier. Every dollar in that all 401k balance is traditional money, meaning the IRS taxes every withdrawal as ordinary income in retirement. Assume a simple 22% tax bracket in retirement, just as an illustrative example, not a prediction for anyone specific. After paying that tax, the all 401k savers balance shrinks to roughly $1.04 million. The split savers Roth IRA portion, close to $700,000, comes out completely tax-free at withdrawal. That happens because qualified Roth withdrawals never get taxed again, no matter how large the account has grown. Add that untaxed portion to the taxed 401k slice, and the split savers after-tax total lands near $1.21 million. That is a gap of roughly $173,000 in spendable retirement money built from the exact same contributions. Same salary, same contribution total, same 30 years, and one saver still ends up with meaningfully more money to actually spend. Before anyone declares the Roth first strategy the obvious winner, there is a catch that spreadsheet cannot capture. A Roth IRA is not available to everyone, no matter how much someone wants the tax-free growth it offers. For 2026, Roth IRA eligibility for single filers starts phasing out at a MAGI income of $153,000. That phase-out fully closes the door at $168,000, cutting single filers out completely above that line. Married couples filing jointly see that same phase-out begin at $242,000 in combined income. It closes completely at $252,000, the identical ceiling that applies to the traditional IRA deduction. Cross that upper number, and the Roth IRA door shuts entirely, leaving the 401k as the only account still open to you. There is a workaround called a backdoor Roth for high earners, but that is its own video, not a quick footnote here. For most savers well under those income limits, though, the Roth IRA stays fully available for the entire contribution order decision. Income limits aside, the real catch is behavioral, not mathematical, and it shows up in who actually funds these accounts. A 401k contribution comes out of your paycheck automatically, before you ever see the money or have to decide anything. A Roth IRA requires you to manually transfer money, choose a fund, and rebalance it month after month on your own. That gap between automatic and manual sounds small, but over 30 years it decides whether the plan actually gets followed. Ask yourself honestly, would you actually log in and invest that money every single month, including the months the market drops? Market downturns are exactly when manual investors tend to freeze, pause contributions, or simply forget to log back in. The saver who picks funds that quietly cost more, or who simply forgets to invest the cash sitting there, erases this entire advantage. So does control beat scale, or does scale beat control? The honest answer depends on which saver you actually are. Give real credit to the 401k first approach, because automatic payroll deductions remove the willpower problem from the entire equation. For high earners locked out of Roth IRA eligibility, the 401k is not just the better choice, it is the only one available. And a 401k built around genuinely low-cost index funds closes the fee gap completely, making its contribution room advantage decisive again. For savers over 50, the extra catch-up room inside a 401k also gives it a scale advantage no IRA can match. Give equal credit to the Roth first approach, because tax-free growth and full control over fund choice are real advantages too. That control also means no employer can quietly swap in a worse fund lineup during the middle of your career. If your employer offers a match, claim it first, always, before any other part of this decision even begins. After that, check your specific 401k's expense ratios against a low-cost broker, since that one number decides more than the account type does. If you sit inside the Roth income limits and your 401k charges high fees, the Roth IRA likely deserves your next dollar. If you are locked out by income or your 401k already runs cheap, sending more toward the 401k stops being a compromise. Both savers made a completely reasonable call here, each one simply optimizing for a different variable in the same math. A bigger contribution limit still carries real weight once the fee gap and the tax gap get factored back into the picture. Remember those two savers from the very start, same salary, same day, same paycheck, split only by contribution order. The real split between them always traced back to contribution order, the one decision most comparison videos skip entirely. Which side of this would you actually be, the automatic saver or the one managing an extra account yourself? Tell us below. Somewhere between your paycheck and your retirement date, another account decision like this one is probably waiting for its own real math. This video is for financial education, not personalized financial investment or tax advice. Run your own numbers or talk to a professional first.